It doesn't have to be like Bitcoin wins or gold wins. I think if I'm right and we're in this inflationary environment, they both should win, and they both should win in a big way. The crisis now is at the sovereign level, and you can add three more zeros to the problem. Lehman Brothers had $850 billion of counterparty risk, and that was enough to potentially bring down the system. That's peanuts now. $850 billion. This is a much larger problem. And who's there to bail out the central banks? What's above the central banks? The IMF, potentially. So we could see a reset, and this could be our opportunity to do a reset of the global financial system away from the dollar.
Welcome to the Gold Republic podcast. My name is Bart Brands.
And I'm Alexei Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
Talking about gold. Totally other topic. We see also just recently, for example, I think it's also good for listeners. You have one of your businesses is in the mining industry, if I'm correct.
Yeah, gold mining specifically. We're a gold producer operating in 3 countries: Botswana, South Africa, and now the United States.
Mm-hmm. Could you please, for educational purposes and give an overview, kind of show, because we're a physical billion allocator, so we get it from our suppliers that mint it for us. How does the role and the importance of miners, which is quite obvious at this stage, but play within the precious metal industry?
It's a very different beast. So gold miners and let's say precious metals miners in particular, and are an entity unto themselves. And as a preface, let me flag a comment made by Michael Saylor, who many people would be familiar with since he's become one of the main champions of Bitcoin. And he said a lot of good stuff. One of the things that I've taken issue to that he said was, if you doubled the price of gold, or the price of gold became $10,000, guys would figure out how to double or triple the production of it. That's something that would more or less be true with a time lag and capex for, say, copper or nickel. Basically any raw material or commodity on Earth. The one thing that's just totally not true for is gold. And I'll give you, I'm giving you a very lengthy answer to a simple question, but let's look at what happened from 2000 to 2011. The price of gold, in round numbers, went from $250 an ounce to almost $2,000, so 8x almost. A huge move. Not a big percentage move, a multiple move, almost an order of magnitude there. And what happened to the production of gold? It went up by less than 2% a year over that time period. Okay, there's a big time lag to get new mines and discoveries online. What happened in the 10 years after that peak in 2011? Less than 2% a year. What happened to the cost of production of gold? It went from industry-wide about $200 an ounce to $300 an ounce to now about $1,000 an ounce. So while it's still very good margins for gold miners, the cost of production, even though the industry as a whole barely moved its total production base, not for lack of trying, by the way, billions and billions of dollars were thrown at it in terms of exploration, new projects and everything. And all we managed to do was keep it going at 1% to 2% a year increase in production. So that is a very important observation in terms of why is gold the monetary metal. There's a bunch of other chemical and physical reasons. It lasts forever. It doesn't oxidize. An ounce of gold is the same as an ounce of gold on the other side of the world. It's the same purity. It's the same ounce, unlike diamonds. And then, of course, the scarcity. There just isn't that much of it. But it is a very important point to understand about gold mining is, if you double the price of gold for me today, over the next 3 years, I cannot produce in my company with 3 different gold and silver mining operations. I cannot produce appreciably more. I would have more cash flow, and I would probably invest a bit more in exploration, which would help me extend my reserve life. It's not going to change anything in my production, certainly not in the next 5 years. Maybe 10 years out, it would help me. But it would help me by percent, not by like double or triple my production. It would have a profound effect on our cash flow, though, of course. But our costs would also rise into that. So gold miners are part of the ecosystem for gold, but very less relevant than, say, copper, where if the price of copper goes below the cost of production, copper miners start to come offline, and the world gets short of copper, and it needs copper every day of the year for infrastructure, for different projects, for wires, for pipes, for batteries, for everything. And if the price gets higher, more projects come online, there's too much copper. You don't need to put copper in bars in a vault in Switzerland or in Hong Kong or Singapore. So there's nowhere for it to go. The price comes down. And it's a natural cycle like it is for most commodities. For gold, most of the gold that's produced, a little bit of it goes into cell phones and other high-end electronic applications. But for the most part, it sits in bars and around people's wrists and necks and safes as jewelry or as gold bullion. And the most important supply of that is what's already above the ground. So if you double the world's gold production, it doesn't actually do very much to the global supply. If you shut it down to zero, it doesn't do very much to the world's supply. So maybe I'll answer with your very simple question of like, tell me how important gold miners are. They're actually less important than you think. I'd say copper miners are more important. Nickel miners are more important. We'd be just fine without any gold miners, and we'd also be fine with twice as many gold miners. It just doesn't change the denominator that much, and that's very important for one of the key reasons why gold is the monetary metal. I'll take you off on another anecdotal tangent, and there's a great spot on our mining property in Botswana where you're basically in the presence of 3 eras of gold mining. And I'll go over different orders of magnitude again. One, 1,000 years ago, the greater Zimbabwean civilization used to mine gold circa 1,000 years ago. To mine and extract gold in that era, you would need, round numbers, 100 grams per ton plus grade, very high grade. That would be unheard of now. Visible gold, you have to be able to see it. They weren't doing chemical assays and running it through their labs 1,000 years ago. And to extract it, it was a very simple process, interaction of acid on limestone to extract the gold. You could see the limestone outcropping with little pits that were made by acid where ancients were extracting gold. Right next to it, about 150 years old, from the late 1800s, a stamp mill that was built by an English company. And we're on the edge of the Kalahari Desert here, so everything's very well preserved. It's not humid, it doesn't rain very much. Standing there looks like it could run tomorrow. This beautiful stamp mill that was used over 100 years ago for, again, mining and extraction of gold. Stamp mill, that would have needed at least 10 grams per ton as the input grade, minimum. Again, visible gold, very simple process, basically a hammer bashing rock into smaller pieces, and you're getting bits of gold out. Gold being the heaviest bit, you can use a gravity type extraction to separate the gold at that point once it's pound down by the stamp mill. And then next to that, not far away, is our modern mill, which the average input grade that we put into that is not much over 1 gram per ton. So what's happened over 1,000 years? So the first 1,000 years, you went from 100 grams to 10 grams. So an order of magnitude reduction in grade that happened. And then over the last 100 years, you went from 10 grams to 1 gram. And that's the industry average now, is about 1 gram per ton. What's going to happen over the next 20 years? Our technology is going to get better, chemistry, physical, mechanical, everything. Our ability to find gold is going to get better. We're going to start processing on average 0.8 and 0.5 grams per ton. And the total amount of gold that we're going to produce, it's going to go up by, drum roll, 1 to 2% a year. That's it. And so all these things, we didn't set out to make gold like this. Mother Nature did. These are the properties that make it relevant as a monetary metal. And I don't think the ancient world knew this. Maybe they did intuitively or practically speaking, that you couldn't just create gold out of thin air. It was very difficult to increase your supply of it. They ascribed a monetary value to it, and we will going forward again in a way that we have in the past.
So the resources space is also maybe somewhere where you could be allocated when inflation hits. And also, you talked about gold a little bit. You talk or a little bit about copper. How about silver?
In silver, I think silver is held back a little bit because it's very useful and very important in various industrial applications. Now that sounds very positive. For example, solar industry is a significant consumer of silver. Obviously, booming, massive growth rates, huge demand drive for silver. So these are all very good things in the normal course. I'm talking about in the explosive, like 10x kind of scenario. I think those things might hold silver back in the sense that you might lose some of the demand because if the price of silver was $250 an ounce, that may make some of these applications uneconomical or stretch the economics indeed. However, having said all that, I think various factors have conspired to leave silver very conspicuously undervalued versus gold and versus paper dollars and paper currencies. So I think ceteris paribus, where gold is now, silver should be at about $50 an ounce, basically double where it is. That's the level that we saw approximately 10 years ago at the previous peak. And it didn't last very long, and it took more of a beat down than even gold did from peak to trough. That's silver's nature. It's kind of like the gold on steroids in both directions, up and down. But for those looking for an investment return, not just preserving their capital, I would say silver might even be the better choice than gold right now. And you may see a really explosive return. Just gold standing still, and you might get 100% return out of silver. Of course, I don't believe gold will stand still. I think gold's gonna move dramatically. Silver's move will be even more dramatic as a result. From a money where my mouth is kind of perspective, our most recent acquisition of my mining company was a silver gold mine. So it was really us adding silver to the mix to our company. It's a past producing mine in New Mexico. And for us, there were a lot of positives about it. It was accretive. It was a great jurisdiction, minimal capex and so forth. But one of the attractions definitely was we added a significant silver component to our production profile. And that was something we were really keen to do, particularly at these prices.
Yeah, I actually wanted to ask about, because now this is getting really interesting. I think about the price of gold and silver. We've seen it also like react in different ways. Also after the FOMC meeting, the Fed, the possible like hike of interest rate that are maybe sooner than what was anticipated. But most importantly, the way the market works. And just today, or actually no, yesterday, there was a conviction in Chicago of a trader from the Deutsche Bank, an ex-trader of the Deutsche Bank, who was convicted for gold and silver manipulation of the market and basically spoofing. So for the listeners, is basically putting a short position without intending of executing it, manipulating in that sense also because those orders are quite big, the markets, and basically pushing the price down of a certain asset. This is one example, and we can say spoofing is also a practice that is unfortunately also happening in other markets. But what is your thesis or your view on this? How manipulated is the gold and silver market compared to other markets?
So I'll use a phrase I picked up from a great macro research analyst named Luke Groman, and he calls them fire alarms. And they said, the traditional fire alarms are interest rates and gold, and it's like somebody turned off both the fire alarms, and the fire alarm that they couldn't turn off because there's no off switch was Bitcoin. and we watched Bitcoin go from 10,000 to 60 some thousand, and gold kind of just sat there. Yeah, it moved up a bit and moved down a bit, but kind of just sat there. And interest rates, okay, nothing's wrong. We're at 25 basis points. Don't worry, the world is fine. Everything's great. So what's the difference between Bitcoin, interest rates, and gold? Why are two of those fire alarms turned off? It's because there's an ability to manipulate them in the sense of interest rates, the policy rate set by central banks, and also enforced through open market operations, buying, quantitative easing, buying securities in the marketplace, basically enforcing the yield. If you remove that buyer, the price of those securities would be lower. You would have less buyers than you currently have. The price of those securities is lower. The yield would be higher. The implied interest rate would be higher. And so the central banks have disabled that fire alarm. They have manipulated through policy and open market operations the interest rate. The single most important variable in all of finance is suppressed and manipulated. The other fire alarm, gold, there's lots of evidence now with things like the spoofing cases. I think the spoofing is actually the least of it. I mean, I'll confess in a public record that, I mean, spoofing was something I did in the equity market all the time. It was common practice. You would, if you're trying to buy something on an illiquid security, you might post large offers, trade around your position aggressively in different forms of what was spoofing. That's not something that it could have a short-term impact on gold and silver. I think the presence of an unallocated market where counterparties with unlimited balance sheets could basically sell or buy, but sell as much gold and silver as they needed to set the price. And if you're willing to sell, and you could sell 100 million, a billion, 10 billion, unlimited amounts without having to disclose anything to your shareholders or have any balance sheet issues, and having no requirement to post a physical amount to match anything of what you are transacting, it leaves it open to manipulation and suppression. And where that falls apart is when those rules change, which is happening. And I think it's almost again, you hear a lot of people in the blogosphere saying the Fed, these guys don't know what they're doing. The central bankers, they've created all this inequality. These guys don't know what they're doing. I'll come back to you and say maybe they know exactly what they're doing, and they're telling us every day when they're speaking. They're just not saying why they're doing what they're doing, but they're telling us what they're doing. They're trying to put forward inflation. They're trying to they're trying to inflate our way out of the debt problem. They're telling us, and they're doing it. And one of the parts of that playbook may be changing the rules around the precious metals market and the unallocated gold market, removing that and saying, here, banks, you can now use gold as collateral, and let's put an end to this unallocated market. And what could happen as a result is a totally different interest in gold, and also remove that ability to suppress gold with unlimited selling of gold that just doesn't exist. You can't do that with Bitcoin, and we saw what happened with Bitcoin. By the way, you can't do it with rhodium either. And if you want to throw up a chart of rhodium or palladium for that matter, look at the moves on those. Those are less liquid, smaller markets that nobody really cares about unless you're an automaker or making catalytic converters or really need those commodities. I don't wake up and look at the rhodium price, and I'm in the precious metals business. But those have had moonshot moves, and nobody's trying to suppress the price of rhodium. You take away the ability to suppress the price of gold. Let's see what it actually does. And I'll just throwing out that thought bubble again. Maybe that is also part of the playbook as well, and maybe they're saying it's time to let it go.
That's really fascinating, because we ask a lot of our guests about what do you think is the motive of the Fed, for example, for doing what they are doing. Are they stupid? But the answer to the question obviously is no, they're not. Otherwise, they wouldn't be there. Something that could maybe segue into this is a Basel III and the net stable funding ratio. I just recorded an episode of our Dutch Goud Quartz, which is Gold Rush. And I was talking about Basel III and how this could maybe, this net stable funding ratio, create a stable transition into a new system. Is that something that you think about as well, or because it seems like
absolutely, and that's what I was alluding to. Like maybe with the corroboration of or collaboration with the Bank of International Settlements, the BIS, that's what's happening, and there is a lot of interface there between all those organizations. My conjecture is that may very well be part of the playbook. And one of the theories, certainly the one that I'm working with, is at some point you will have a reset in the price of gold. And I'll paraphrase Ernest Hemingway and say, ask, how did you go bankrupt? And the answer was, well, very slowly at first, and then all of a sudden. I think that's going to be the move in the price of gold. You may actually have just this moment where it makes a step change type move, and that's your reset. So you got to be in it for that. If you miss that, you're going to be waking up to a very different situation. And this may seem like some arcane legislative change from a mystery bank that nobody really understands anyways, but it may actually be one of the important things we look back at 5 years from now and say that was one of the, why didn't we talk about it more at the time? That was one of the signposts, and that was one of the key inflection points on the revaluation of gold and of all of these assets. I think if you see gold move from $1,800 to $2,500 and $5,000, it's going to change a lot of things. And the question is, do the central banks want to turn that fire alarm back on? And if they didn't, so why Basel III? Why this change? Why this change in the rules around unallocated gold? Why are they doing that now?
Would you think that it could suddenly move the price of gold, or would it be at first some gradual price rises, after which maybe it starts to really take off, like you just alluded to?
I think that it's. I really doubt that it has some sort of the day of impact on gold. This is well telegraphed, well understood. We know the dates when each country falls under this legislation and under the new guidelines. So it's not like anybody's like, oh my God, now I have to cover my massive gold short position. If there was any lingering position like that, people would have been dealing with it already. What it takes out of the equation is the ability to do unlimited short selling without any physical behind. You just can't manipulate gold going forward. So the next time gold wants to move or silver wants to move, they'll be able to. So let's see, when is the rubber going to hit the road here? If gold starts to get ripping, there won't be a 4 a.m. dump of $1 billion of gold. and one of the simple tests, like I've pondered it for years myself, is that working with in the resource industry, and before that for a long time in the investment industry, and in Canada, where of course we're very focused on resources and mining, people saying, gold's manipulated, and you wonder, well, but why, other than this fire alarm theory? But if you were a economic commercial beast and you wanted to sell $1 billion of gold, would you do it all at once at 4 o'clock in the morning if you wouldn't, to get the worst possible price? Or would you do it in a more subtle way, phased in, to try and get the best price? Of course, the latter. So it is conspicuous to anyone with two neurons to rub together to feel like, nobody in their right mind would try and sell anything that they owned in this way unless they had a secondary motive. These sales that we've seen for years and years and years, don't look like sales made by somebody who wants to get the best price for what they own. They look like sales from people wanting to manipulate the price downwards. And that's been entirely possible for infinite balance sheet entities with an unallocated gold market.
And that would be central banks? What kind of institutions?
The central banks primarily, the Bank of International Settlements, and also potentially a Treasury departments. But I think or the equivalent finance ministries, depending on the country. But I would say central banks.
Mm. So we have here in the Netherlands, Willem Mindelkoop, who was a big proponent, or wrote in his book, The Big Reset, that there will be a moment in his eyes, and also like based on the expert views that he collected, that there will be basically a re-emergence of gold as the main key cornerstone of the monetary system. And Basel III, with this allocation, that's basically those institutions can't now like hide with unallocated assets, be the first step that will build the foundation of coming back to like this unhindered, unlimited supply of paper flooding the market. Do you believe that, how do you believe this will, based on what I just said, transform the monetary system as we see it today? And also, so taking that same question, how will it grow next to Bitcoin, or rather the inverse? How will Bitcoin evolve in parallel towards that setup?
So let me break that into two questions. The second being tying in Bitcoin. The first, the reset, and what that might look like. In my view, is that if you look at what asset central banks, for all these accusations of manipulation, they are the largest owners of gold in the world. If they didn't think it was worth anything, as Alan Greenspan said, well, why do they have trillions of dollars of it? And since 2008, been net buyers, particularly and conspicuously Russia, and also, of course, China. What do they know that they're not telling us, or they are telling us? And we're not listening. I think this crisis that we're in doesn't feel like a crisis, with the stock market at all-time highs and interest rates at all-time lows. Again, fire alarms turned off. Is an order of magnitude, or multiple orders of magnitude, larger than the 07-08 crisis. So that was particular sectors, and it was call it a corporate level crisis that created a liquidity crisis that was systemic in nature and very dangerous. Total disaster was averted. The crisis now is at the sovereign level, and you can add 3 more zeros to the problem, where the Lehman Brothers had $850 billion of counterparty risk, and that was enough to potentially bring down the system. That's peanuts now, $850 billion. So this is a much larger problem. And who's there to bail out the central banks? They're the ones who effectively were writing checks and were the buyers of last resort, and the facilitators that saved the system. They came through and did their job when the too big to fail entities started to fail, and created all this systemic risk. Who's going to bail them out? What's above the central banks? The IMF, potentially. So we could see a reset, and this could be our opportunity to do a reset of the global financial system away from the dollar. One of the obvious ones that's been bandied is the SDR, and that system, which was kind of went dormant for the better part of 30 plus years, was reactivated in the 07-08 crisis, and not in a huge way, but everything was turned on again, and the system was shown to work, and that the SDRs could be issued, and the SDR bond market was created, SDR dealers, basically all the ecosystem that you need for a reserve currency. That's all been turned back on again in the modern sense, and in the interconnected global sense and digital sense. So that system's there, ready and waiting. It also potentially, if you have a basket, the SDR, for those who are not familiar, a basket of the world's major currencies, you could peg the SDR, special drawing right is what SDR stands for, to gold and have that at a fixed ratio, enforcing a sound money policy on the world, and yet still have the benefit of a floating currency system with your renminbi, yen, euro, and dollar all floating around against each other inside that SDR. So Japan's fortunes are booming and they're exporting lots and importing very, very little. The yen can still go up versus the dollar. And then that situation reverses and the dollar is doing, or the United States is doing really well. The dollar can appreciate versus the renminbi and the euro. And still in that basket as a whole be pegged against gold and have enforce a sound money policy. You can't go to town with your money printing. You're stuck inside that. You're stuck inside that sound money policy, but with the benefits of a free market floating currency within that basket. So I think that is something that the global system and those in power are talking about, and at least like pressing the buttons and running the alpha and beta testing to see if all the gremlins are out of the system, and getting it ready to see if it can work. Will it take that form? Will it be something totally different driven by the IMF, or will it be something totally different still beyond that? Only time will tell. But that's my base case scenario, that there will be some sort of mixed free floating market and sound money type structure that's put in place and facilitated by the IMF, and that we'll see that maybe sooner than people think. And I'm talking in less than 10 years. Things are happening very fast right now. It could be a lot sooner than that. Second question you posed, or concept you posed, is like, what's the role of Bitcoin and how does it evolve in this? I think, again, I go back to it being the fire alarm that nobody could turn off. And we saw the flow of funds into Bitcoin, and then, of course, it's sold off recently from its highs. But still, this could be a major asset, hard sound money, hard asset, a hard asset that we don't hold in our hands, but it's a hard asset by the technical definition nonetheless, in portfolios, or that we use as an asset to store value going forward. Maybe it's some other cryptocurrency, I don't know, but I think there is a potential there for that to become something. And it doesn't have to be like Bitcoin wins or gold wins. I think if I'm right and we're in this inflationary environment, they both should win, and they both should win in a big way. If I had to pick one, if I only could pick one to bet on, I'd bet on gold, and I obviously have, because I started a gold mining business, and I come from the belief that because governments are here to stay and they're not going to disappear, and they own most of the gold, they're going to use that as the basis for a reset. But I've also been directly involved in Bitcoin mining and the whole cryptocurrency ecosystem as an investor, and think that probably, if you ask me which one's more likely to produce a larger percentage gain and create more wealth, it would probably be some smart investments in cryptocurrency, because it's just such a disruptive and important inflection point in the evolution of cryptocurrencies. So if you put a gun on this side and said pick one or the other, I'd pick gold. And he said pick one which is going to perform better, I'd pick cryptocurrency. I might not pick Bitcoin right now. I might pick another one, but I would probably pick cryptocurrencies.
I think it's been very enlightening. I'm not sure, but I think it's been an amazing talk up until now, and a lot for viewers to think about. So let me say thank you very much for your time, and we would love to have you back maybe sometime in the near future. It was amazing, very enlightening.
If you would resume this conversation in one punchline as a exercise of extreme intellectual synthesis, how would you synthesize this conversation?
That's a great question. I'd say, well, we had a good free flowing discussion of what does inflation mean to everyone, and what are the key topics that where should we focus our time and energy thinking right now. I don't think it's like, let's think about this over the next year. This is a now thing, and this is current, this is imminent, and this is something that we all need to be thinking about, investors and people who aren't investors alike.
Everyone in this environment, and this is a very good point, I think, and that's what we also talked about before we started recording, everyone starts noticing the importance of their position beyond their bank account, their saving accounts, because that saving account doesn't yield anything anymore, and start realizing that there's a bigger game they have not been seeing their whole life before, and they start waking up.
And now is the time to start playing.
None of us, in our 40s or 30s have lived through this. Never mind 20s or younger. We haven't seen this, and it's something that affects all of us in our 365 days a year. This is not something for fund managers and talking heads on television to worry about. This is really a universal effect, and we could be right as we're speaking, seeing a system change, and so that will obviously affect all of us too. And we could all really benefit from spending some time thinking about what can we do now to change how we're set up, whether as an investor or just in our lives, to protect ourselves so that we can thrive in whatever the new environment is.
True. Well, amazing wrap up. Well, Ravi, thank you again very much for spending your precious time with us. Well, to all our viewers and the listeners, of course, if you've liked this video, please give it a like. If you have any questions, feel free to put them here below in the comment section. And if you haven't subscribed to the YouTube channel, please do. Alexei?
And if you've listened to this podcast on either Spotify, iTunes, or any other podcast platform, leave us a review and share it with someone you think it might be relevant to. And until then,
till the next episode of the Gold Republic podcast.